Welcome everyone to the Answers On series here in Davos. Today our focus is global taxation. I'm joined by Mark Weinberger, EY's Global Chair and CEO, and Brian Peccarelli, President of the Thomson Reuters Tax and Accounting Division. Welcome to both of you. I want to start with a broad theme question, and that is, of course, US tax reform is a big topic on the agenda here. Lots of happy-looking chief executives wandering around. The global context is good. The global growth story is good. More optimistic than normal?
I certainly think more optimistic than the last 7 or 8 years we've been at Davos, where we're now having synchronized global growth, broad-based, not only just business optimism, but consumer confidence. Interest rates are low, wages are rising. So a really positive story, I think, across the board. It is a lot driven by some of the U.S. tax reforms. It's also driven by a strong China, re-engaged India, and a lot of the deregulation.
Sure. Is that the sense you're getting as well, Brian?
Yeah, that is, and I'd agree with Mark on that. I mean, I think it has been the highest in the past several years, and kind of runs across the board. Are we
out of the US making too big a deal of this tax reform and the race to the bottom story when we consider some of the rates elsewhere around the world, in Europe, for example?
Yeah, so you're not making too big a deal when you say this is a landmark tax change in the United States, because it brought the rate from 35 to 21, massive changes in not a 35% tax on bringing your capital back, full expensing, things like that, very positive. But to your point, Axel, we're bringing the rates down to where they are in the rest of the world, around the average of 21%, and the international system is now commensurate with almost every other OECD system across the world. Yep. It is not some haven. One point that people don't realize, the base erosion provisions to prevent companies from moving their income overseas and eroding the U.S. tax base are some of the tougher ones we've seen across the board. Disallowance of interest deductibility, a minimum tax across the world. So there's a lot in this bill.
Okay. In fact, let me come on to BEPS and the way this tax reform impacts the whole issue, the tax transparency piece and BEPS. Let me ask you first, Brian.
Yeah, well, I think when you look at it, not just the U.S., in 2017, eight major countries lowered their tax rates. Hungary is all the way down to 9%. Kind of leading the way there. So is this an outcry from BEPS, and the transparency and everything else going on in it, that it's kind of leveling the playing field across the board? As Mark said, the U.S. is catching up with what others have already been leading and driving down their rates. So I think, it's a tough argument maybe, but when you see that transparency and everything that BEPS was bringing about, you're seeing these countries all kind of level themselves out.
Sure. And what are our clients? What are our clients at Thomson Reuters saying about this?
Well, I think, they're concerned about what does it mean, the changes and everything else for them, because it's still calculating out and figuring out what it means for them. I think it's for both our organizations, working with our customers there to help them figure it out and help them lead through these changes. For Thomson Reuters, we've been making these changes and seeing major, tax revisions throughout history. Since we've been in business for over 50 years doing the tax compliance. This is a major change in everything, but we're there to support our clients and lead them through the change.
Same for you, I guess.
No. Every business that is either in the United States or a business outside the United States operating in the United States will reevaluate their structures, because they were all set up for a different world now. They used to try and defer their foreign income so they wouldn't pay taxes. They used to try and keep money out of the United States because they had the highest taxes. Now they're going to rethink that and try and think more about an economic deal as opposed to trying to prevent these higher levels of taxes. Yeah. But also, in some cases, redo their system so they'll get lower taxes by coming to the United States. That's going to cause a lot of changes in tax structures.
How does FDI get impacted by this?
FDI will depend on the tax changes. So clearly now U.S. businesses, that $2.5 trillion that was held overseas with the 35% toll charge could come back. I think that might mean some less will be invested overseas. But it's not going to be just a rush to bring all the money back to the United States. People will invest where the after-tax return is good and the market for their goods and services is best. Tax is only one element in that decision.
So you agree with that?
Yeah, to me, what it's done is it's taken out having to do things and doing things that maybe aren't normal, because of taxes and high taxes in one jurisdiction versus another, and allows them to start rethinking how should they operate, how should they do business, how should they streamline operations, how should they set up their supply chains, and kind of not have to try to do things around tax.
For a couple more brief things. Far be it from me, Mark and Brian, to be the doom monger here, but if we've talked a lot about trade here in Davos. If we see a really big shift in trade, if we see something really big happen, i.e. the bite become the bark, or the other way around, the bark become the bite out of the US, I mean, this is going to change the landscape for you guys.
Well, if you see major trade wars, or if you see companies can no longer take advantage of the rules of NAFTA, so they can't get component parts into the United States to put it in U.S. factories that are going to be built to build products, that will undo some of the benefit. But there's no doubt that the expensing provision, the lower rate, are still going to be, certainly for domestic taxpayers, a big change. So it won't undo it, but on the margin, it will make it some of those decisions change.
Yeah. Any other trends, just to finish up, Brian, in global taxation that we and our clients and EY's clients need to be looking out for over the next year?
Well, I think they've got a lot to deal with right now.
Yeah.
You know, looking at it, I think the other area that they have been dealing with is a change in indirect taxes. So the GST in India, what's going on in the GCC countries with VAT coming out and rolling out through different countries. So again, it's not just direct taxes that we were talking about in the rate changes. There's a lot of activity going on around the globe. Again, trying to level the playing field and create revenue streams that are reliable for governments.
Yeah.
I totally agree with Brian. There's one other thing that's really important, which is there's this huge repatriation tax. There's a new way to calculate these base erosion taxes. There's not enough information for companies to be able to figure it out today. The IRS is going to be releasing rules and Treasury regulations. They'll be coming piecemeal as they start to figure this out. So taxpayers are going to have to really keep an eye on what's coming out of IRS and Treasury to figure out how to do this in the right way.
All right, gentlemen, thank you very much indeed. Brian Peccarelli and Mark Weinberger. That was Answers on Global Taxation. I'm Axel Threlfall.